I have been staring at this chart for 3 days. Something is wrong. Something that nobody is talking about. Something that changes everything we thought we knew about Friday's crash. At first, I thought I was seeing things. I pulled up the data again, checked different sources, compared multiple charts, but the numbers did not change. And the more I looked, the more disturbed I became. Let me show you what I found. This is silver. Friday's crash, 39% down. The biggest single-day drop in modern history. You probably know this already. Everyone is talking about it. Every headline, every analyst, every YouTube video. Silver crashed, retail got destroyed, trillions wiped out. But this is what nobody is showing you. This is what kept me up for 3 nights straight. This is SIL, the Silver Miners ETF. The companies that actually dig silver out of the ground. Real mines, real production, real businesses with real employees and real equipment. Now, here's where it gets strange. Miners always move more than silver. Always. If silver goes up 10%, miners typically go up 20. If silver goes down 10%, miners typically go down 20. This relationship has held for decades. It is one of the most reliable patterns in commodities. On Friday, silver crashed 39% from its peak, the most violent drop in history. If the pattern held, miners should have crashed 60%, maybe 70, maybe even 80, but they did not. Miners dropped only 22%. I stared at this chart for hours trying to understand how is this possible. The entire silver market is collapsing, trillions being wiped out, retail investors getting destroyed, and the mining companies, the ones whose entire business depends on silver prices, they barely moved. It made no sense. And then it hit me. Smart money did not sell. Think about this for a second. The institutions, the hedge funds, the pension funds, the family offices, the people who manage billions of dollars, the people who have teams of analysts, the people who have access to information that you and I will never see. They did not panic. When silver was crashing 39%, when retail traders were getting margin calls, when portfolios were being liquidated across the world, the big players looked at their mining stocks and said, "No, we are not selling." Why? Why would they hold mining stocks when silver is in free fall? Why would they not dump everything and run for the exits? There's only one explanation. Because they knew something we did not. They knew the crash was not real. That thought kept me up all night. If the crash was fake, if smart money knew it was coming, if they positioned themselves perfectly while retail got slaughtered, then there has to be evidence. There has to be a trail. So I started digging, and what I found made my blood boil. Welcome to the hidden economy. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now because this is the kind of analysis you will not find anywhere else. And if you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see it. Now let me show you what I discovered. In my last video, I showed you how the crash was scripted. 72 hours, Tuesday to Friday, a perfectly coordinated trap. On Tuesday, Trump signaled a weak dollar policy. Every trader in the world heard the same message. Weak dollar means strong precious metals. The trade was obvious. Hedge funds piled in, retail traders went Allen, billions of dollars moving in one direction. On Thursday night, silver hit $121. All-time high. Euphoria everywhere. People were talking about $200 silver, $300 silver, early retirement. Then Friday morning, 6 a.m., before markets even opened, Trump announced Kevin Warsh as the next Fed chairman. Kevin Warsh, a strong dollar hawk, the exact opposite of what Trump signaled on Tuesday. Tuesday, weak dollar. Friday, strong dollar, Fed chairman. Same president, opposite signals, 72 hours apart. The traders who shorted the dollar on Tuesday were now forced to buy it back. The traders who bought silver on Tuesday were now forced to sell. Forced reversal, forced liquidation, 40% destruction in 6 hours. And somehow, while all of this was happening, the mining stocks barely moved. If you have not watched that video, link is in the description. It shows you the full 72-hour timeline. But today, I'm going deeper. Today, I'm showing you who did this, the names, the documents, their documented criminal history. Let me start with something that most people have never heard of, spoofing. Spoofing is a form of market manipulation where a trader places large orders they never intend to execute. Here's how it works. Imagine you want to buy silver at a lower price. You place a massive sell order, thousands of contracts. It looks like someone is about to dump a huge amount of silver on the market. Other traders see this giant sell order and panic. They think someone knows something. They start selling too. The price drops. Then at the last second, you cancel your fake order. You never actually sold anything, but now the price is lower, and you buy at the cheaper price. That is spoofing. It is illegal. It is fraud. And for over a decade, the biggest banks in the world were doing it in precious metals markets, and they got caught. Between 2008 and 2020, 5 major banks were convicted of rigging gold and silver markets. Not accused, not investigated, convicted, found guilty, hundreds of millions of dollars in fines. Let me read you the charges. JP Morgan Chase. September 2020, the Commodity Futures Trading Commission issued an order for manipulative and deceptive conduct and spoofing that spanned at least 8 years. Hundreds of thousands of fake orders designed to move prices. The fine, $920 million, the largest penalty ever imposed by the CFTC. But it gets worse. The traders who did this did not just get fined. They went to federal prison. Michael Noak, JP Morgan's head of precious metals trading, convicted of racketeering. Racketeering, the same charge they use against organized crime against the mafia. Greg Smith, JP Morgan trader, convicted. Jeffrey Ruffo, convicted. Christopher Jordan, convicted. These are real people, real names, real prison sentences for running a criminal enterprise inside one of the biggest banks in the world. And JP Morgan was not alone. Scotiabank caught $127 million fine. HSBC caught $76 million, 9 years of cheating. Deutsche Bank caught $75 million. They were rigging markets since 1999, 15 years before anyone noticed. Morgan Stanley caught. 5 banks, all convicted, all fined. And guess what? Not a single one went out of business. Not a single one lost their trading license. They paid the fine and went right back to work. This is not conspiracy theory. This is court records, government documents, public filings that anyone can look up. For over 2 decades, these banks were manipulating precious metals while regulators looked the other way. They only got caught because of whistleblowers. And even then, the fines were pocket change compared to their profits. $920 million sounds like a lot, but JP Morgan made over $40 billion in profit in 22-20 alone. The fine was a rounding error. Now, here's the question that kept me up at night. Do you really think they stopped? A bank pays $1 billion fine. Their traders go to prison. They admit to running a criminal enterprise for 8 years, and then what? They just decide to play fair. These are the same people, the same desks, the same strategies, the same incentives. The fine was a cost of doing business, a speeding ticket, a line item in the budget. Let me show you what I found when I looked at Friday's data. This is the COMEX delivery report from January 30th, 2026, the exact day of the crash. This document is published every single day by the CME Group. It shows exactly who is trading, who is closing positions, who is taking delivery. Most people have never seen this document. Most people do not even know it exists, but it tells you everything. Look at this column. It says stopped. In futures trading, stopped means contracts that were closed, positions that were exited. If you were short and you stopped a contract, you closed your short and took your profit. Now look at line 6061. JP Morgan Securities stopped. 147 contracts. 147 contracts closed on the exact day of the crash. Let me explain what this means. When you are short silver, you profit when the price goes down. JP Morgan had short positions. On Friday, silver crashed 39%, and at the exact bottom, JP Morgan closed 147 contracts. They exited at the lowest price of the day. Maximum profit. Perfect timing. Now think about this. Thursday night, silver was at $121, all-time high. Every analyst was bullish. Every headline was positive. 12 hours later, silver crashed to $75. $46 erased in a single session. And somehow JP Morgan knew exactly when to close. They did not close on Thursday when prices were high. They waited. They did not close in the middle of the crash when it could have bounced. They waited. They closed at the exact bottom. The same bank that paid $920 million for rigging silver. The same bank whose traders went to prison for manipulation. The same bank that admitted to hundreds of thousands of spoof orders. That bank just happened to time the exact bottom of the biggest crash in history. You believe that was luck? Now look at who else is on this document. Morgan Stanley, 31 contracts stopped at the bottom. Deutsche Bank, 58 contracts stopped at the bottom. HSBC, 60 contracts stopped at the bottom. You seeing the pattern? The same banks, the same names, the same players who were convicted of rigging precious metals, all closing positions on the exact day of the crash, all exiting at the exact bottom. This document is public. Anyone can access it. It is on the CME website. I did not hack anything. I did not bribe anyone. I just looked at data that is available to everyone. The evidence is right there in plain sight. When I first saw this, I had to read it 3 times. I thought I was misunderstanding something. There had to be an explanation. But there it was in black and white. The same criminals, the same timing, the same playbook. And now I understand why the miners did not crash. Smart money knew. The institutions knew. The funds that hold mining stocks, they knew this was not a real collapse. They knew it was manufactured. They knew the banks needed to cover their shorts. So they held. They did not panic. They watched the paper market burn while they sat on real assets. Miners down 22%, while silver crashed 39%. That is not a coincidence. That is a signal. But wait, the evidence does not stop there. Let me show you what the CME did after the crash. CME Group runs comics. They set the rules. One of those rules is margin requirements. How much cash you need to hold a futures position. On Friday after the crash, CME announced margin hikes. Saturday morning, less than 24 hours later, they announced another round. Starting February 2nd, margin requirements are going through the roof. Gold up 33%, silver up 36%, platinum, palladium, everything. Massive hikes across the board, 36% increase overnight, no warning, after already hiking on Friday. Let me make sure you understand how insane this is. If you are holding a silver futures contract, you need a certain amount of cash in your account. If margins increase by 36%, you suddenly need 36% more cash. Most traders do not have spare cash lying around, so they get liquidated, forced to sell, whether they want to or not. Higher margins equal forced liquidations equal lower prices. Now here is what should disturb you. If CME wanted to prevent volatility, they would raise margins before a crash. They would cool down the market before it gets out of control. They would reduce leverage when things are getting frothy. That is what a responsible exchange would do. Instead, they raised margins after the crash, then raised them again the next morning, then scheduled another hike for the following week. Think about that sequence. Friday, silver crashes 39%. Retail gets destroyed. Friday night, CME raises margins. Saturday morning, CME raises margins again. Sunday, CME announces more hikes for Monday. They're not protecting investors. They're finishing off the survivors. The crash took out everyone who was leveraged long. Now, the margin hikes are taking out anyone who held on, anyone who thought about buying the dip, anyone who still has a position. This is not risk management. This is a coordinated execution. And it tells me something very important. Someone big is in trouble. Think about it. Why would CME raise margins twice in 3 days to emergency levels? Why 36% overnight? Because someone is underwater. Someone has massive losing positions. Someone is about to default, and they are scrambling to protect the clearing system from the fallout. The crash on Friday was not selling. It was not profit-taking. It was not a correction. It was a forced liquidation bloodbath designed to save someone big at the expense of everyone small. Now, let me put this in historical perspective, because what I am about to show you proves this is not random. This is not market forces. This is a playbook. This is not the first time they have run this exact play. 1980, silver ran from $6 to $50. 800% gain, regular people making fortunes, the Hunt brothers trying to corner the market, everyone talking about silver. What happened? CME created Silver Rule 7 out of thin air. Banned leveraged buying overnight. Changed the rules in the middle of the game. No warning, no explanation, just new rules that destroyed anyone who was long. Result, silver crashed from 50 to 10. 80% destruction. Thousands of investors wiped out. 2011, silver ran from $8 to $50. Another massive rally. Social media buzzing. Retail traders piling in. The silver squeeze movement was born. What happened? CME raised margins 5 times in 9 days. 5 times in 9 days, 84% increase in margin requirements. Result? Silver crashed from 50 to 26. 50% destruction. It took 13 years to recover. 13 years. And now, 2026, silver ran from $26 to $121. The biggest rally in history. Social media on fire. Retail investors euphoric. What happened? CME raises margins before the crash. Raises them again during the crash. Raises them again after the crash. China raises margins at the exact same time. Fed chairman announcement time for maximum damage. Banks close their shorts at the exact bottom. Result: silver crashes 39% in a single session, the fastest destruction of the three. 1980, 2011, 2026. Same pattern, same tools, same playbook, same destruction. Every time silver threatens to break free, every time regular people start making money in precious metals, every time the price starts to expose the weakness of paper money, the same script executes. Once is an accident, twice is coincidence, three times is policy, and that is exactly why smart money held their mining stocks. They have seen this movie before. They know how it ends. They know the price always recovers after the manipulation. The miners are telling you something. They're not selling. They're holding. They're waiting because this crash was not real. It was paper manipulation, manufactured chaos, a coordinated attack to shake out weak hands and let the criminals exit at the bottom. The physical market knows the truth. On Friday, when COMEX said silver was $75, dealers around the world were selling physical silver for $120 to $150, a 40 to 100% premium over the paper price. If silver was really worth $75, why were buyers paying double? Why were coin shops sold out? Why was there a line at every dealer in America? But here's where it gets even crazier. I want to show you something that happened this weekend. Something that tells you everything you need to know about the state of the physical silver market. Golden State Mint, one of the largest private mints in America. They just shut down silver sales for the entire weekend. Their statement, quote, "not able to secure silver," end quote. Let me say that again. One of the biggest mints in the country could not get silver. They had to stop selling because there was no metal to sell. The last time this happened was during the co-panic in March 2020 when the entire world was falling apart, when people were panic buying everything, when the financial system was on the edge of collapse. That is the only other time in recent history that a major mint had to shut down sales because they could not source metal. And it just happened again this weekend right after Friday's crash. Think about what this means. The paper price says silver is worth $75, but the physical market is so tight, so stressed, so completely broken that one of the largest mints in America cannot even buy silver to sell to customers. If there was real silver available at $75, do you think Golden State Mint would shut down? Do you think they would turn away customers? Do you think they would publicly admit they cannot source metal? No. They would be buying every ounce they could find and selling it at a premium, but they cannot find it because it does not exist at these prices. The paper market and the physical market have completely disconnected. The paper price is fake. The physical price is real. And the gap between them is not just wide anymore. It is broken. Friday did not just crash the price. Friday shattered the physical silver market, and the cracks are spreading faster than they can contain them. Now let me tell you what I think happens next. The shorts have covered. JP Morgan closed their positions at the bottom. The other banks followed. The manipulation has served its purpose. The weak hands have been wiped out. Retail traders who bought on margin are gone. Leverage positions have been liquidated. The market has been completely cleaned out. But here is what they cannot control. The supply situation has not changed. Silver is not optional. Solar panels need it. Electric vehicles need it. Every phone and computer on the planet needs it. You cannot build the modern world without silver. Demand is exploding. Supply is flat, and that did not change on Friday. Friday's crash did not create new silver mines. It did not reduce industrial demand. It did not change anything fundamental. All it did was transfer silver from weak hands to strong hands at artificially low prices. And now the physical market is breaking. Mints shutting down. Dealers sold out. Premiums through the roof. This is not what a healthy market looks like. This is what a market under extreme stress looks like. I think the recovery is going to be violent. When this turns, it will turn fast. The same algorithms that drove it down will drive it up. The same leverage that wiped people out will make fortunes on the way up. And the physical shortage is only going to get worse because every crash like this one drives more people to buy physical, more people to take delivery, more people to remove their silver from the paper system entirely. The banks can manipulate the paper price, but they cannot print physical silver. And right now, the physical market is screaming at the top of its lungs that something is very wrong. But I also think something bigger is coming. The margin hikes tell me someone is in serious trouble. You do not raise margins 36% twice in 3 days unless someone is about to blow up. The coordinated timing tells me this is global. The physical market breaking tells me even more. When a major mint cannot source silver, when premiums are 50 to 100% over spot, when dealers are turning away customers, that is not normal volatility. That is a system under extreme stress. Something is breaking behind the scenes. I've seen these patterns before in 2008 and 2020. The stress always shows up in strange places before the big crash hits, and right now the stress is everywhere. In the margin hikes, in the physical shortages, in the desperate timing of the Fed chairman announcement, in the coordinated actions between CME and China. I believe a major market event is coming in the next few months. I do not know exactly when, but when I decide to exit completely, I will say it here publicly. Like I always do, a lot of people will regret not paying attention sooner. Now, let me leave you with this. 5 banks convicted, hundreds of thousands of spoof orders, traders in prison, and on Friday, they closed their shorts at the exact bottom. The miners did not crash because smart money knew. The physical market did not crash because the paper price is fake. Golden State Mint shut down sales this weekend, could not source silver. The last time that happened was Kyo. The physical market is breaking in real time. 1980, 2011, 2026. 3 times in 50 years. Same playbook, same destruction, same recovery after. This is not a free market. This is a crime scene. The question is, what are you going to do with this information? If this video opened your eyes, I need you to do one thing. Send this to someone who lost money on Friday, someone who got liquidated, someone who is sitting at home right now wondering what happened to their portfolio, someone who deserves to see the evidence before they make their next move. That is how we spread the truth, one person at a time. Drop a comment below. After seeing this evidence, do you still trust this market? Are you holding? Are you buying? Are you getting out? I read every single comment. Your feedback motivates me to make more exciting videos. If this is your first time here, subscribe right now. Hit the notification bell because the next video might be the warning that saves your portfolio. You can also join my channel if you want detailed price action analysis. I bring regular updates on gold and silver so you can stay ahead of the market moves. I will keep digging. I will keep exposing. I will keep you updated. This is the hidden economy. The fraud is exposed. The evidence is clear. The names are on the record. They want you to panic. They want you to sell. They want you to give up and walk away. They want you to believe the paper price is real. It is not. That is how they win. That is how they have always won. Crash the price. Create fear. Buy from the panicked at the bottom. Do not let them shake you out. Now watch what happens.